we can start. I just have to turn down the music. All right, there we go. There we go. Okay. Yeah, you got it right. Anyways, welcome. Good to see you. Comment allez-vous? How are you? Let me bring up the software. Oh, we're over there. Oh, interesting screen. Supposed to start here. Hey! Let me remind you that trading's risky, not appropriate for everyone. I'm just reading your... What are you guys talking about? Anyways, I'm just reading what you guys are talking about. Anyways, hey, let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Hey, welcome to National Don't Be an Asshole Day. Anyways. Holy smokes. Anyways, hey, interesting day. For some of you, you hung out at FX Bootcamp for over 6 hours yesterday. Holy smokes. So, hey, busy day yesterday. Kind of a repeat today. Jay Powell's going to testify in front of the Congressional Finance Committee, and basically to do the same thing and do Q&A with other people. I don't think the message will be the same, but anywho, that's going to happen. We have ADP today. I think we have Bank of Canada today. Hey, Bank of Canada is not going to raise interest rates. Interesting, huh? So another segment of a very interesting week. And then, of course, the doozy is non-farm payrolls on Friday. And then next week, I'm guessing Wednesday, that's probably CPI, Tuesday or Wednesday. Cool, right? So anyways, interesting week. Dollar strong as one would suppose. So that worked out really, really, really well. Very happy with how things went yesterday. Will CAD not rising be good or bad? Well, I suppose they're not raising interest rates because it would hurt a weak economy. So I don't think good, but you know, who knows? It's an interesting psychology, right, JGB? Like maybe it's a relief. Yeah, but why? Why is it why can't they raise interest rates? So, anyways. So we'll have to do that one together. So, anyways, I guess we'll burn through the charts today. Let's make it a chart day. So let me know what you want me to cover, and I will be happy to do that. Remember non-farm payrolls I will be doing at FX Street's YouTube channel on Friday. For some reason, they don't post it very early. Let's see if I got a link for you. Yeah, interesting. I'll have to say, like, why don't they like set these up in advance? Anyways, no, they don't seem to have anything available to sign up for. You know, I should hit them up on that. But you know, it's their business. They can do whatever they want, right? Okay. So anyways, look, let's get going. In the description below, there's a link to my book. Check it out. There's a link to fxbootcamp.com. We're a community. It's been around 20 years. Many members have been active for, let's say, between 20 and 10 years. People are still around. I think it just shows you the quality of our community. That, yeah, you, as a new member of FX Bootcamp, you will bump into people that have been members for 10, 15, 20 years. I don't even advertise it really. So it's kind of interesting, right? So, hey, join. It'll make a difference, honestly. So join FX Bootcamp. And then lastly, there's a link to Trader's Way. Go there and open up a demo account. They're in a foreign exchange broker. You should have a good one. Yes, fast execution speed. Yes, narrow spreads. Yes, huge swaps. But trust. Trust is the big one. They earn my loyalty and respect, and I recommend them to you. So check them out, tradersway.com, or click the link in the description below the video, or don't click the link in the description below the video. Do what you want, but go check them out, tradersway.com. We'll zip over here. This is just kind of where we left off yesterday in the day trading group. Wayne, Japan says they're going to raise wages and not looking to raise interest rates. That doesn't make sense because the central bank doesn't raise people's wages. So anyways, so going back to this X marks the spot was like, if it pulled back, then be prepared to have one trade there and another one higher. And I'm like, I'm not sure if we're even going to get there. And well, it didn't drop more, nor has it really risen. We're only like, if you're going to use an hourly chart, we're only getting there now. So yeah, you could wake up to a potential move like this now. It's mediocre, but what else are you going to do, huh? Ahmed says, I guess yesterday's live stream. Yeah, all members. All members. It was all members of FX Bootcamp. Ahmed, it's $88 a year to be a member. All members. We had a good time. Yeah, it was a really good time. So anyways, so yeah, you have a maybe continuation here. It's a maybe. We're at 66. Okay, so anyways, that's that. Pull back here, that's a maybe. Pull back here, that's a maybe. These are all in 4 hours. Let's go to the indice. Just kind of check out where everybody is. Usman says, do you think Bitcoin will fall and drop in price? Of course it will. Remember, I don't think, I do analysis. So of course. Okay. So, yeah. I mean, yeah, that's all I can really say. Like, I've covered it so much. I'm like, well, of course it would. But anyways, let's take a look. Is anybody surviving this? A little bit of yen strength, a little bit of Swiss franc strength, a little bit of dollar strength. That's all risk off. Okay. Well, Usman, another good question. He says, do you think CAD Swissy will fall? Okay, well, tell me, what's the S&P 500 going to do in the next 3 days? Usman. Okay, so then what do you think my answer is? Remember, I don't have an opinion. I have a bias. So what do you think CAD Swissy will do if the S&P 500 is going to fall the next few days? Well, of course it would. Right? But you're asking me things like, do I think this and do I think that? Look, if your bias is the S&P 500 is coming down, you should have 20 different trades, 30, 40 different trades. Okay? Okay, my opinion and my bias are two different things. My bias is based on research. Doesn't mean it will, for sure, right, Maida? But the thing is, you should know exactly what you believe will happen. So, like, when somebody asked me, like, CAD Swissy, I'm like, well, it was this. My thought on that is the same as yesterday, the day before that, the day before that, and the day before that, and the day before that, and the day before that. So that's why I'm like, you either set it up or you don't set it up. It's either the right time and price or it's not the right time and price. But my fundamental bias is my fundamental bias. And that bias comes from research. It's just macroeconomics and monetary policy. Simple. So I get to, like my super secret fundamentally based alert service, it will just say strong sell is a bias. So then I go to my chart. Do I strong sell today or not strong sell today, right? So anyways, so we could look at a CAD Swissy. Why not? Let's just do it. Do it. I don't want to do it. Don't go chasing your emotion. All right. Gee whiz, how did I do that? Okay, well, anyways. All right, so here we are. Let's go to a 4H. Okay, what do you think? Okay. Sell it off the 4-hour 21. All right, sweet. Okay. Maida says up, so she's either trading the range or she's bullish on macroeconomics. I'm a bear on macroeconomics, so I'm like, I would never buy that. So I would sell it off the 4-hour 21. Boom. Easy peasy lemon squeezy. Now this says be prepared for sideways for the rest of the week, really, because we hit target early, so you could have a pullback. So maybe that's also what Maida might be trading as a counter trend. But even though I know they exist, I'm always going to go for the trend. And this move from here to here is different from the move from here to here. One of them is, this is a change in market sentiment. Okay? The market over the last couple of days has changed their opinion for the terminal rate at the Federal Reserve Bank of the United States of America. Thank you, Jimmy. It's coming in hot. Uh-oh, it's coming in hot. So anywho, so this, I believe, is trading. Okay. This is like technicals. And then this downward move is fundamental, not technical. And so that's where, if I may be so bold, is if I were to assume a break in the range, because really this isn't really trending anywhere if you measure it this way. But because the move from here to here is directly related to monetary policy. This isn't non-farm payrolls, which assumes monetary policy. It's not ADP. It's not CPI. It's not PCE. It's not Michigan's consumer sentiment. It's not the Philly Fed. This is the chairman of the Board of Governors and Federal Open Market Committee for setting interest rates for the United States of America. And he schooled people. And yes, if he has to put 2 million people out of work, Senator Warren, well, inflation hurts every citizen of the United States, not just the 2 million that are going to have to lose their jobs. Okay. So anyways, so I would argue, okay, this move is different from the others, and therefore you could try, and it was the whole conversation yesterday in the day trading group, to get short. And so now you're like, but Wayne, what does this Jay Powell testimony have to do with Swiss franc? Risk off, Swiss franc strength. Risk off, Japanese yen strength. Risk off, US dollar strength. Remember, I'm a macro trader, and I believe this is all Newtonian physics. Well, Warren doesn't like the Fed. So it was not surprising. And you can see even Powell was kind of pissy back. So they don't like each other, for sure. Well, Jim, yeah. I mean, I don't care one way or the other, but, she is who she is. She says what she says. She represents people who elected her that think the same way. Otherwise, they wouldn't have elected her. So it's, you want a democracy. So great. She was clear on what her opinion was. And I think that's important. Makes America great. I think the United States maybe should consider moving towards being like the British and the Canadians. And it's really interesting when you have a parliament and not just two parties kind of thing, like many parties creating coalitions, and they're face to face screaming at each other. And you don't really get that in the United States. They backstab each other, but they don't yell at each other face to face. Kind of interesting. But so anyways, Elizabeth Warren is very clear what her opinion is, and that's great. Imagine another situation, and I'm not suggesting like Jim. I know what you're saying. So I'm not coming down on you, Jim, but I'm just saying in general for all of us to think about, that is one of the strengths, that we can have such opinions, obvious opinions. There's some weaknesses for, let's say, being so polarized where you're so right wing or so left wing that there is no common sense. But I suppose even worse than that is you get a place like China where there are no dissenters. They're all gone now. She's been around for long enough. Now there is absolutely no dissenters. And in fact, she doesn't even ask opinions of other people. He doesn't have people for feedback. He doesn't want feedback. And there's certainly nobody going to push against him like, are you sure, President Xi, maybe you should reconsider a few things? Okay? No, that doesn't exist. So, I like the fact that, that a democracy can do that. Because you get, I suppose, better representation and better opinions and all that kind of stuff on the long run. The problem with democracy is it's too slow. Who do you think could build a 1,000-mile railroad faster, China or the United States? Trucking mogul, yeah. Trucking mogul's like having multiple parties in Congress is a great idea. Yeah, and it'd be great if, you could split off the more radical units. Democrats without socialism would be a good one. Republicans without religion would be another great one. It'd just be really interesting. Like the parties are actually kind of confusing to me. They seem to contradict each other. Like one is, you should have the right to carry a gun, but you can't have an abortion. Like, I don't understand that one. And so both parties have these sort of contradictions. So it'd be interesting if it was much more fragmented. But whatever, I'm not here to talk politics. I'm just a country bumpkin from Saskatchewan. I ain't no American. I ain't no fortunate born. So whatever. I'll let the Americans figure it out. I'll just live in this great country. Pay my taxes. Usman, look at all these questions. Great, Usman. But the answer to that is, of course. But again, I don't think. So you should rephrase your questions. But look, I look at the economic data. Of course it is. Okay, so yesterday, one of the things that Elizabeth Warren pushed against Jay Powell with, she said the last time there were 12 times in history in which the Fed raised interest rates by more than 2% in a year. How many times of the 12 did we not go into recession? So Usman, what did he say? Like, don't ask me about my opinion. Who cares? I'm a peon. I'm a nobody. I'm like a YouTube live streamer. Gee, right? So what did Jay Powell say, the head of the Federal Reserve Bank of the United States? What did he say? Of the 12 times the Fed raised interest rates more than 2% in a year, how many times did the economy not go into recession? What was the answer, Usman? Good. So you don't need to ask me what I think or my opinions are. Right? So it's, so you're right. 0. So answer the question. Do I think? Well, first of all, I don't think. But by the way, just so you guys, everybody can get a taste of this. So you might say, if you didn't watch and do the work, first of all, kind of shame on you, but you might have a job and all that kind of stuff. So I get it. But here's the thing. I think it was probably 3 or 4 swing trading group meetings ago. So maybe a month ago. I think not quite. I think maybe 3 weeks ago, 3 meetings ago. So I guess that is pretty close to 4 weeks because the next meeting's tomorrow. I actually went through a chart that I pulled up. I created the chart using the Federal Reserve database live. So I just went to it's actually called the FRED. It's at the St. Louis Fed's database. So anyway, so I went directly into the database. I generated the chart. I showed inflation and interest rates and recessions. And we went through each recession since, I think, 1980. And we went over the cause and the effects of the cause of the inflation, the cause of the recession, the central bank policy that happened at that time, and the reaction of the economy. And we went through this like we're even, dare I say, with certain an air of arrogance, we FX boot campers we're like 5 levels above even that stuff of how many times did the United States go into recession when the Fed has done this. We've actually analyzed the quality of, like we qualified each of the recessions and how are they similar and different to today's scenario. You see what I mean? Like, dude, if you're not part of the groups, man, you're so far behind. Okay? Like, everybody here should be part of FX Bootcamp because we have that type of conversation. And if you're like, I don't understand, you just have to say, and if I'm not available to help, we have a huge community of people that can help. Okay? And how many YouTube live streamers can pull up a Fed database and generate those reports in less than 30 seconds and then do a deep dive into the conversations? Yeah. Anywho, Luftleitulumum. Okay? And again, if that comes across as arrogant, I do apologize. You should interpret it as I have a love and passion for what we do, and FX Bootcamp is the vehicle for me to share with like-minded people. So I think it's the greatest thing in the whole world. Okay. Anyways, Natty, we'll just leave that there. I was waiting to see if there was going to be a bounce. Now we're held down on that 21, so be careful. Okay. Bitty, can't you see? Thank you, Adam. Okay. What do you think about that? A breach lower is going to be something else, huh? So when I say, oh, well, of course Bitcoin's going to fall, how do I get to that bias? Well, I say, well, I think the stock market's going to fall. That's why I'm 20% cash and triple leverage short. You know this, I already told you. So great. So once again, more than think, I'm actually going to benefit from a stock market fall. Cool. So I think the stock market's going to go down. Why? I've looked at the economic data. Economic data shows that. Cool. Okay. So the economy will slow down and people will lose their jobs eventually. And it seems like it's going to take a while, which means the Fed might have to go even higher than everybody thinks. Okay. Cool. Well, okay, great. So if you're worried about losing your job, or you do lose your job, what are you going to sell to pay your rent? or your mortgage? Well, at first you burn through your cash. But we know Americans don't have any cash. I've looked at the average bank account. But I suppose middle-class Americans, they got some cash, right? What do you have, 3 months cash in your rainy day fund? I don't know how much you keep around in cash. I think that used to be the rule, 3 months. All right, cool. So 3 months later, after losing your job, now what? You ain't got no cash. So now what? Now you're left with a choice. Do you take a penalty and cash out a retirement account? Do you sell your house and buy a cheaper house or go rent? Well, you can't sell your house. Nobody wants a 6% mortgage. And you don't want to give up your 3% mortgage. Plus, you got equity in your house. But then what? You do pull your equity out, but you lost your job, so you can't get that. So, okay, so no. Okay, so you leave your house alone. What about your retirement account? Well, you've already lost money, 20%, because of the stock market being down. Plus, then you'd get penalized quite a bit for taking out a retirement, so you don't really want to do that. Then you're like, well, what about that Bitcoin? You got some Bitcoin. You're like, you know what? To pay my rent, to pay my mortgage, to put food on the table. Okay? Maybe you sell your car, maybe you sell your Bitcoin, maybe you do a garage sale. But the thing is, Bitcoin will be something that you sell. You can't dump your house. You can't dump your retirement account. So you do a garage sale, right? You sell your G-Wagon to buy a Volkswagen. Hey, good call. By the way, I don't understand people that pay $80,000 for a Volkswagen Touareg. But anyways, you sell your G-Wagon and you buy a Volkswagen. Great. You do a garage sale and you sell your Bowflex. Okay? That kind of stuff. And then what? Maybe if you bought a Rolex, you sell that. What else? Well, your Bitcoin. Okay, yeah, sell the Bitcoin. Great, great, great. So when you're searching for liquidity, using sort of different terminology, you dump your Bitcoin. I think a lot of institutional investors that are long Bitcoin, they're using derivatives to hedge this, but I think retail probably are getting out, right? Because you got to eat. You see what I mean? So you have to think of like behavioral finance when we talk about, do I think Bitcoin's going to fall? Well, of course it's going to fall. You can't eat Bitcoin. You can't even hold it in your hands. Okay? Well, you can touch your house. That's real. Okay? You need to buy, well, you can't even afford chicken now. Poor Americans, right? $10 for a pound of hamburger? Nah, forget that. $10 for $5 for a pound of chicken. Well, forget that. It used to be 97 cents. Now it's $5. What do Americans eat? Salmon? Rather die. It's so funny how many Americans were like, just fish. They're like, oh, I don't like fish. Why don't you like fish? It tastes fishy. But anyway, it's like, oh no, Americans are running out of protein. Huh? Chef Boyardee? So anyways, like consumers are having to make choices and shift. There's avian flu in the United States. 51 million birds, I think, have to be put down. So eggs are high, chicken prices are high, cost of beef is high, and all that kind of stuff. So it's very interesting. Yeah, actually, no jokes. My son, many years ago when he was young, they must have all been about 12 or 13. He threw a party where all his buddies came over. So we had 9 guys hanging out at the house. And we were doing a bug tasting party. So they all came over and we ate crickets and mealworms and all kinds of things. Yeah, cricket meal. So we did all that. And we're like, how cool is that? Richard is like, have been on an all fruit diet. Now, I think that's horrible. Now, I'm diabetic, so like I can think of all the things like, okay, you have outrageous amounts of sugar. It would be the first thing. Right? Probably outrageous levels of acidity going into your bloodstream. Okay. Cool. All right. So another question. Okay, good. Okay. Let me do this. I intended to jump through charts, and I'm bogging myself down with macro, and then we have some other interesting questions. But okay. But let me address what do I mean when I say I'm triple leveraged short? Okay. So I own the S&P 500. Okay. I literally own it. I also own various stocks that are probably either in the S&P 500, but they're large cap stocks. I've been moving over into mining companies and stuff like that. I'm in some EV type plays and stuff like that. But, a hodgepodge of stuff in my retirement account. But I think probably 20 or 30% are just indexed. Okay. And then others are specific plays. So when the stock market first fell, you have to understand the stock market was up. For those who are fairly new, the stock market was up and up and up. And I started telling people 6 months before the crash, if you want to call it the crash, that in January, the stock market was going to fall at least 10%. And I started saving money for the drop. Okay? Interesting, right? So there was sort of this level of preparation. Okay. And then what? I started doing things like when it dropped, and it was the first wave down, I believe. Okay. When it dropped, I bought retirement homes. Okay. Old folks' homes. I bought liquor stores. I bought dollar stores. I bought prisons. Oh, I bought apartment buildings. And I even bought distressed commercial real estate. Literally office buildings. Literally office buildings when it was the worst thing you could possibly do. Well, that's when you want to buy when people have already left. So that's what I did in the first wave of down. Okay. But I made the call. By the way, can anyone confirm this? That we talked about it like pretty much every day for 6 months while the stock market was going up. That I'm saving money. It's going to drop at least 10%. It's going to come in January. I got this money. I'm saving. I'm going to buy a dip. I'm going to buy in the first quarter. I'm going to let it fall, and then I'm going to roll into this. Right? I mean, Jim says absolutely. And it's like the same thing to my answer with Bitcoin. Is Bitcoin to drop? Well, of course it's going to drop. I mean, of course. I mean, dude, look at the data. I mean, again, it's not my opinion. If you look at the data, well, of course it's going to happen. So I prepare 6 months in advance, 3 months in advance, 1 month in advance. Then it happens, and then I actually carry out my strategy. Now, I think every one of these is profitable. If you just looked at this portfolio separate from what I was already in, even though the stock market dropped 20%, I think this is profitable, all of it, right? Okay. So anyway, so that's the first wave. And somebody asked, well, what do you mean by triple leverage short? So if we carry this out a little farther now, and by the way, if you weren't there, as I was buying these stocks, I would tell people, oh, I just bought a bunch of dollar stores. Oh, I just bought a bunch of liquor stores. Oh, I just bought, right? By the way, my prison stock is up like 30%. 30% in a down market. I'm doing all right, son. All right, so then we had this sort of move like this, and then, so this is the second wave. Not the big second wave. I think we have a big second wave potentially coming down the road, but sort of the second half of last year. Okay? So there was the first half of last year, then the second half of last year, when we were sort of top-ish, I got triple leverage short. Okay, so now I'm going to answer the question. Okay, there's an ETF called SPXU, which is short the S&P 500 using 3 times leverage. So for example, if you had a $40,000 account, okay, and you cash out 10,000 of it, so now you have 30K long S&P 500 and 10% cash, then you take 10% cash and you buy SPXU, okay, it would fully hedge because you'd be short 10,000 times 3. So now you have a fully hedged portfolio. 30,000 long SPX and through leverage 30 times short SPXU, or actually long SPXU, but SPXU is short S&P 500. You see what I mean? Let's go! Okay. So that's what I mean. Like, so what I did is a little different. Because being short, you can also be wrong. And triple leveraged is risk. So what I did is, think of it this way: short, but leverage short. Okay. But we'll create this sort of as like small short. Yeah, I guess that's better. Okay. So I have relative to the portfolio, it's a small short leveraged up 3x to be a reasonable short, but I have a bigger amount, okay, in cash, which is an assumption of a short without any leverage. Okay. Now you're like, but Wayne, first of all, cash is trash. You're losing money, especially with inflation. I'm like, yes, okay, but remember, this is my retirement account. So just by me putting money in this account, the money is free for now. Think of it as a tax return. Kind of feels like you get free money. A check shows up. You're like, dear Denise, this is the IRS. You overpaid your taxes, Denise. Here's $10,000. I'm like, oh, Denise is like, $10,000 free money. Boom, boom, boom. No, it's actually your money, right? And I don't think they pay you interest on that money that was overpaid, right? But anyway, so when it goes into the retirement account, it comes out of the corporation as an expense. So it was money you never earned. So on the short term, it's free money, because I won't have to pay taxes on it. It's money that doesn't exist. So just tucking it away in here is a huge benefit. Remember, I can tuck 50 grand. I think is the max. I think it's 52 grand a year. So for those that have gone through the Rule of 72, which I've done a few times recently, dude, just take that. 50 grand compounding at 8% a year or 10% a year. Let's say 10%. For decades, you're like, dude, that's an insane amount of money. And they're like, yeah, well, that's just my tax strategy. Do you remember what Trump said in the debate with, who was it? Was it with Hillary? I forget even who was he running against? Was it Obama or Hillary? Or I can't even remember now. It's so funny. But anyways, during the initial debates, remember that? And he's like, the system's rigged. And they're like, well, President Trump, why do you say it's rigged? Yeah, was it Hillary? And he's like, because I use it. I use it every day. That's why I'm a billionaire. Okay? So it's like the system is rigged. Did you guys know that about America? It's totally rigged. I learned this from a tax attorney 20 years ago when I needed help with my trading taxes because it was crazy complicated, right? So I hired a tax attorney, and here's what he told me. He said, Wayne, there's 2 taxation systems in the United States. All the rules of the IRS are set for 2 different constituencies. Poor people, okay, and owners. If you own stock, if you own real estate, if you own a trust, if you own corporations, you get treated significantly different from someone that has a job. If you get paid for your time, you are poor. I don't care if you make $590,000 a year as a lawyer. I'm like, so you have billable hours? Yes. Well, then you're poor because you can't leverage up your time. You can't triple your time. You can only triple the time, the amount you charge for your time. But you only have, 24 hours in a day. And you can't work 24 hours a day. So you can never get big. Now, if you own the law firm and you start hiring a bunch of other lawyers, well, now you're an owner and there's a difference. And so rich people don't have any money. You have to understand that. Wealthy people don't have any money. They just own a bunch of stuff like real estate and corporations, right? Right? So anyways, there's 2 different taxation systems and that's why it's rigged. And if you get paid, what do they call them? A 1099, and it shows up and they're like, oh, you worked 2,000 hours and we paid you this amount of money and you got to pay your taxes, you get crushed. Okay? So anyway, so that's all Trump was saying. And this is all I'm saying, like, I want you to be successful in Forex, but I also want to teach you the game. And it's just the rules of the game. Like Trump said, he knows the system's rigged. He uses it every day. That's how he's rich. Okay? And that's why he doesn't pay any taxes. I mean, it was such a funny thing how people were bugging Trump. And again, don't misinterpret me like I'm a Trump lover or something. I'm just a macroeconomist. Okay? So he does, people were, I guess people were pointing out that he doesn't pay any taxes. But that's what I'm telling you. Wealthy people don't pay taxes. Their businesses pay taxes. Right? Well, of course, but everyone, I mean, it's the law. I mean, that's what people forget. It's not that he's cheating. It's the law. It's the way it's designed to work. Okay? So in America, if you own stuff, you don't pay taxes because you don't earn a salary. Your apartment building doesn't pay you a salary. Your LLC doesn't pay you a salary. Your stock investments don't pay you salaries. You don't earn money. You might have like distributions or dividends, which are taxed, but then you might take losses on other things which are a part of normal business. And you might, like, for example, if you own $1 billion worth of real estate, you will not get paid a salary, and you won't even make the majority of your money from rent. What ends up happening is in the United States, you make all your money through depreciation. So Trump might not have any income or money or doesn't pay taxes, but then you get these huge depreciation things. Like you have to understand the business. So of course he doesn't have any money. That's how real estate works. So you make all your money through depreciation. And so what does that mean? Every year, so let's say you buy an apartment building. And you go out and you get some investors, you get some banks, you pull all this deal together and you buy a $100 million building or a $100 million property, whatever. Okay, great. Now every year you depreciate the property. The IRS gives you a schedule. Here, depreciate it this way. Okay, which means on the books, the value of the property goes down, 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 down. That's what depreciation means. And you get a little credit for that. Actually, a big credit for that. Well, why does this matter and how do you make money? Well, 5 years later, what's happened is every year, the value of your property has gone down, 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 down. But in reality, the property has probably gone up, 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 up. Usually, right? And then what? Every 5 years, commercial real estate has to be rolled over. It's like a 30-year mortgage that has to be renewed every 5 years. It's priced like a 30-year mortgage, but it only lasts 5 years. So now you got to go back to the bankers and renegotiate. Because a banker doesn't want to be locked in at a certain rate for 30 years. You just go back and you renegotiate based on new market conditions, right? So what's happened is you've depreciated the asset for 5 years in a row to the tune of, let's say, $1 million. But the property value has gone up $1 million. That's only 1% each way. It's actually probably more than that. You could argue it's 5 million depreciation, 5 million appreciation. So then you renegotiate with the bank at the new high price, but your mortgage has fallen because of the depreciation. And guess what happens? Trump, being the owner, for example, puts the $10 million in his pocket. No distribution, no salary. It's like think of it this way. Here's a better way of thinking about it. You own a house. You've been paying down your mortgage every month for 10 years, and then you decide you want to put in a swimming pool or something, or put in an extra bedroom. So you go to the bank and you're like, can you give me an equity loan, a home equity loan, okay, to build a swimming pool or to add an extension, screen porch or something, right? And they're like, yeah, well, let's take a look. Okay, you've paid your mortgage down, so you owe less and less and less. In fact, you have a significantly smaller mortgage on the original purchase price, but now we agree your home is worth more, so we will let you take some of that equity out as a loan. Now, is that loan to you income? Do you pay taxes on that? Is it like a job? Did it pay you a salary? No. You pulled equity out of your house. So all of a sudden, like, Trump doesn't pay any taxes because that's how he gets paid. The depreciation schedule, the mortgage, and the mortgage amortization is the next thing. So there's depreciation, amortization, and then every 5 years, one of his properties has to be rolled over, and each time he might pocket $10 million, but he owns hundreds of buildings. So 2, 3, 4, 5 times a year, they're rolling over and they're like, Mr. Trump, $10 million. Mr. Trump, $10 million. Mr. Trump, $10 million. But it's not income. He owns. You see? So of course, that's why he doesn't pay any taxes. You see? So anyways, it's the game, son. It's the game. So anyways, I'm playing the game here. And I will buy, in fact, I'm going to buy, I'm going to build a dividend portfolio. Okay. Focusing on basic human needs. I might even start a fund called that. Okay. So I'm going to build a dividend portfolio and a covered call portfolio, or maybe combine them. Because the problem with covered call is it'll do really well over the next 5 years, because I think we're going to be sideways for 5 years. So I want to be income focused. So I want to collect dividends, and I want to collect premiums on writing options backed by a portfolio, right? So I'll have this for a nice little sideways action. Okay. Kyle, what does it do, Kyle? If it says it won't load. My guess is you are not logged into your correct Gmail account. Yeah. Yeah. You're just not you're in the wrong Gmail account. So anyways, I was thinking about going back and going through maybe a regulatory process and then set up a fund for you guys. Wouldn't it be cool if you could just like do something similar? Or Usman, I don't know. How would I know that, Usman? Think of it. When you ask the questions, think of it. I'm like, how would I know that? So anyways, let me ask you guys, it would take me a while, but let's say next year, would anyone be interested in a stock portfolio fund that I create that's focused on income, not necessarily asset appreciation? Now, of course, if you're going to hold the assets for 10 years or something, of course, you would assume in the next 10 years, the stock market would go back up. But to build a portfolio that paid high, let's say, even monthly and quarterly dividends. Okay. Yeah, Richard, I think I'll do that next year, but I got a lot of stuff going on. Like, I can't even get through a day. But just a thought, like, I'm like, oh, gone. So I would set it up like, I mean, it almost acts like a hedge fund if you're thinking about this, where the goal is to somehow have a low beta to the market. So you'll have less volatility would be the design, or right? The attempt would be to have a low beta stock portfolio but high income. So, like for example, I own BHP, right? BHP. Okay. If the stock was flat this year, how much money will I make? See, like it starts with that. What if you thought the stock market was going to be flat? Yeah, it's going to go down, it's going to go up, and then it'll close, and okay. So the stocks just kind of fart around, but generally doesn't do anything. And it closes at the same price. But you have to have the opinion, if you will, that the stock market's not going to perform. How much money do I make? What's my return on that investment, assuming the stock doesn't change in price? Type in a question mark if you don't know. $10%. I will earn 10%. I've been paid a few dividends just in the last few days. I keep getting pings. Pa-ching! You just collected a dividend. Pa-ching! You just collected a dividend. Money, money. It's a rich man's world. Yeah, baby. So what if you just had a bunch of these? You know, some are 10, some are 5, some are 6, some are 7. Various different industries, different, all that kind of stuff. But you just kind of build something up and you let that compound because you think, let's say you thought the S&P 500 was going to be, let's say, between 3,000 and 4,000 for the next 3 years. Is that a reasonable probability? Well, when is the Fed going to stop raising interest rates? We don't even know. When are they going to cut? We don't even know, and I don't expect that to be next year. Honestly, I don't think it's going to happen in 2024. Shoot, it was priced in to be September's 2023. I thought that was wrong then. Now it's early 2024. I still think that's wrong. I think it's 2025. So how would you invest? Or 2026, Cherokee? Yeah, maybe. It's too far to go that, but I'm just like, not now. So what would you do to make money, honey? So that'd be cool if I could just build a portfolio for that, for you. Okay. You imagine collecting dividends every month? Pa-ching, 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 pa-ching. Okay. But that would be people with less than, $1 million. I mean, that'd be people like putting in 10 grand or something, right? 5 grand, 10 grand. Now, if you have more than $1 million, ooh la la. I can make you some introductions, brother. Okay. But wouldn't it be cool if you could build a portfolio that could plausibly make 10 or 15% every year, no matter what? The issue is the up years you'll probably underperform, but probably not much. So I don't think we're going to go back to 25% years in the stock market, right? Like we were doing before with free money. I think it's going to be decades before we do that. But let's say 5 years from now, the stock market is recovering and we do have 10 or 15% up years. Well, then I think if you designed a portfolio that's focused on income, if the stock market was up 15%, you'd probably be up 10 or 12%, but not 15 or 20. But the thing is, in the years where the stock market is down 5 or 10, you would still be up 10. So it'd be like, is that what you want? Well, that's why it's income focused. You see what I mean? In the down years, you don't sell your stock, but you're earning income. In the up years, you're earning income, but the stock market's going up. But to earn the income, you're kind of limiting your upside, especially if you're in a covered call strategy. You see? But that consistency is how you design a portfolio for an endowment. So one of my classes at Harvard was focused entirely. The entire class was focused on managing money for endowments. Okay, my professor used to run the largest museum endowment in the world. He ran the money. He ran the money for the Metropolitan Museum of Art in New York City. He had retired and became a professor. So then we spoke to the current one. We also had the manager for the Yale endowment come and speak to us in person. Imagine running Yale's book. But the thing is, they have different goals. Their goal is in perpetuity. What does that mean? The money has to last forever. A museum, let's say has a $10 million endowment, okay? And the $10 million endowment produces $1 million return every year. The museum lives on the $1 million, pays the rent, pays the power bills, pays the salaries, purchases the exhibits. They need that $1 million a year. Now, they don't care about having more. It's a museum. But they can't have less. You see that? If you can't produce, they have to lay people off. So they want the consistency. You understand? They're not trying to turn $10 million into $20 million. They want the $1 million a year. Now, as you get closer and closer to retirement, you're probably that way too, right? You're like, dude, just make sure, right? Make sure that 10% rolls in. But can you design that in an up year and a down year? Most people can't, right? Okay. Risk averse. Well, and yeah. See, the risk is when the stock market's going up, if you're in a covered call position, you'll accidentally get knocked out for profit. Now, it's not that you lose money per se. So imagine this, just so you guys understand that strategy. How do you earn income from that? So let's say I build a portfolio and we own a bunch of stock. So I own a bunch of things. And they probably too are, let's say, a dividend producing stock because I want the income. But I want in a down market, okay, let's say I suppose even right like in this period here before the Powell's speech, okay. Let's just say I own this S&P 500, okay, and I bought it down here, okay, and I believe this is what's going to happen, okay. So I own it. I literally own it. But I want to earn some more money. So I write an option. I don't buy an option. I don't buy a put or a call. We write one and we say, I agree to sell you my S&P 500 trade at 4,200. Okay, and for that you have to pay me $200. Okay, and the idea is when we get to expiration of the option, so I write an option and I sell it to somebody for $200. So I collect the $200. If the stock market in the future is above 4,200, I have to sell this position here to them for 4,200. Let's say it's at 4,300. It doesn't matter. I have to sell it to them. But I already own it. So it's kind of like having a limit order. So I own it at 38 and I have to sell it to them for 4,200. Did I lose money? Not really. I could have made more money, but look, I collected the $200. And I thought the stock market was more likely to fall than rise. You see that? So most of the time, if I'm right, of course, I just collect the $200 and the option that somebody paid $200 for expires worthless. So I just collect the $200, and that's what I mean by income. So I earn some money. I found some sucker, some loser that was making bets based on hope that the stock market was going to go higher. And I'm like, that's stupid. I've done my research. I've done my homework. I've done my analysis. There's no way that's right. So easy $200. You know what I mean? Easy $200. Sucker! Sucker! What a loser! Right? Meanwhile, I'm collecting my dividends too. The companies are paying me. How about making, so anyway, you're doing that. You're doing that. You're doing that. But what happens if the stock market does rally? Well, hell's bells. You get out of some of the trades early, but for profit. So you unfortunately now are making money on the asset appreciation, but not on the income side. So now, see, the problem is now you got this cash and now you have to go buy a new stock at the higher price. Like, you don't actually want to get knocked out, but if you get knocked out, you're getting knocked out for profit. You see what I mean? So anyways, I was thinking of like a fund-to-fund model where I put a bunch of funds like this, covered calls, structured Forex, dividend, high yield dividend. And we build this portfolio of just like 3 or 4 ways to make money, assuming the stock market is either sideways or down. If the stock market's not going up, how do we make money? Wouldn't it be cool to have a way to do that? So part of the portfolio is making 30% a year. Part of the portfolio is making 20% a year. Part of the portfolio is making 10% a year. Maybe part of the portfolio is doing nothing or taking a small loss, which is kind of a hedge. And you blend it all together and the stock market's down 20% and you're up 10% plus income. Huh? What do you think, R2? Yeah, he likes it. So anyways, food for thought. Food for thought. Yeah, food for thought. Question is, if I go through and do all that, do you have to be an accredited investor to invest? I think it would probably have to be for fairly wealthy people, but maybe not. I mean, I don't know. And by the way, a portfolio like that, it would have to be a retirement account. A 401k, for me, it's a SEP account, SEP, separate something, SEP, I don't even remember what it stands for. It's a 401k for a small business, basically. So your retirement, and it has to be a retirement account. Does anybody know why? I suppose it doesn't have to be, but it's advantageous, very much advantageous for a retirement account. Does anybody know why? Taxes. Why? No, but why? I mean, okay, that's what a retirement account's for. But why in this particular case? Is that what it is? Simplified employee pension plan. Cool. See, I have a pension, Kyle. I never thought about it that way. I have a pension. I just have a free trading account. Free money. Free money trading account. Well, Peter hits it, but it's sort of like, it's not capital gains. It's income. Ordinary income. Because if you're earning dividends or you're earning money from writing options, you're selling somebody an option and earning income. It's ordinary income. Now, I kind of like the idea you're selling people worthless pieces of paper. It feels like a central bank, right? So anyways, so if it's in a retirement account, though, you defer, right? And so that you write down that, right? Well, the thing is with like IRAs, or as they say in California, IRAs. I was talking to somebody here in Georgia about an IRA, and he didn't know what I was talking about. Oh, an IRA. So anyways, the only thing is they're tiny, right? Like you can't put a lot of money in them. And then there's a Roth IRA and non-Roth. I'm not a wealth advisor. I was talking to a friend of mine the other day who he's a fund manager now, but he started in wealth management. And he said something the other day, which was great. And he's like, he hated it. He's like, I don't care about your retirement. I don't care about, right? Like, because, you know, what happens is you're a wealth advisor and you sit down with your clients and you're like, I think you're spending too much. I think you need to be putting more aside in your retirement account. I think you're putting too much on your credit card. I think you should be putting money aside to send your kids to college. I think you should be doing all this stuff, right? And of course, nobody listens to you. So you go through this whole process. I've analyzed your entire life and all your spending and all your savings and your future needs. And this is what you should be doing with your money. And everyone's like, nah, forget that, right? No one listens to you. So anyways, he's like, dude, Just give me your money and I'll manage it. Forget about the wealth advisory side. Nobody listens to you. So you're like, yeah, and I can get that. So you're like, I just like the money side. Makes a ton of sense. But anyway, so the difference between an IRA and a Roth IRA, I don't know these things. They're not very much big. I don't think you could put 100 grand into one. You know, I think they're really tiny, like, what is it, 16, 15 grand or something. And it is, so anyways, I don't know what they are, but a basic 401k, basic retirement account, like a SEP, totally, I think, appropriate, because you wouldn't have to worry about getting dinged at a higher tax rate on the income you're earning from writing options and collecting dividends. And meanwhile, we're trying to keep a low beta. So imagine the stock market was falling, but you are collecting dividends and you are making money from writing options. You're hedged. So it's like, okay, the stock market dropped 10% on paper, but you earn 10% in cash, money in the account. What actually happened? Nothing, but you got $10,000. Now, the paper value of your stock portfolio is down 10%. But let's say in 10 years, is it still going to be down 10%? No, probably in 1 year, it's back to where it was. So now you're back to zero, but you collected another 10%. Then in year 3, the stock market is now up 10%. Plus you collected 10%. So now you're like, okay, let's look at the total return. Stock market up 10%, so your portfolio is up 10%. Plus you collected 10% in income, so now you're up 20. Plus 10% the year before, you're up 30. Plus 10% before, so you're actually up 40% over the period. Your total return over 4 years is 40%, but your portfolio, the actual stocks themselves, are only up 10%. So what was the beta? Well, the stock portfolio was down 10%, flat, up 10%. So the beta was fairly low, but you're earning income through it. You see? And that would be like, that's kind of what you want. And then, of course, if I thought the stock market was going to go up, I'd try to earn less money on the covered call side and move more toward dividend and asset appreciation. But that would be just money management. You see what I'm going at? Hey, guys, it's only money. I don't know how we got here today, but I hope you enjoyed the conversation. No, I'm not going to watch Powell. Already know. Everybody knows. So the trade plan for gold, kick it off that hourly 21. We looked at a currency that was similar, kick it off the 21. S&P 500, go into a smaller time frame. Okay, kick it off the Lucas bands. Bitcoin, probably not up. Zoom in here. Okay, riding. See, we already had the pullback to the 21, so you're already way late. I got to do a transaction on that, and I'm really worried. So I'm going to be watching Bitcoin fairly closely today because I got to do a transaction in Bitcoin today. And I don't want to be like stuck in the middle 3 hours trying to confirm the transaction and Bitcoin drops 5%. You're like, so yeah, scared about that one. Looking at the exotics. Okay. Today, I hope to get knocked out for profit on this trade. Okay. Let me move this out of the way. Okay. Oh, I deleted the wrong one. Delete, regression channel, delete. All right. So I'd like this to make a lower low, and I'm going to get knocked out after a month of holding this short. This is a follow-up trade because you remember I exited here. Oop, where's my drawing tool? I exited here after a 3-month hold. So I was short for 3 months, took profit and re-entered here. And now I've been short for 1 month. And we're going to get out here. Why get out now? I'm probably concerned about the end of the quarter. I'm already thinking about April. Snap! Shut the back door. That's crazy. Huh? Yeah, because of my expectations for April. So I got to get out in March, Bubba. Give me the full Monty. Now, this is an out of position trade. I could go for lower, but one in the hand is worth more. One in the hand is worth more than two in the bush. Do you know what that means, by the way? It comes from the Egyptians who used to practice falconry. So you would have a bird on your wrist. You would go hunting with the falcon. Okay? And the hunter would scare birds out of the bush. So there's 2 birds in the bush. You'd scare them out of the bush and they would fly. Okay? And your falcon would catch them in midair, kill them, and bring them back to you. So the bird in your hand is worth more than the 2 in the bush because the bird over its lifetime will kill 100 birds in the bush. So anyways, all I'm saying is, yeah, maybe it's going to be worth more, but I'll laugh about it when the money's in the bank, right? So that's that idea. Give me my money. Okay, down there. We'll see. So that's good. That play's already happened. It kicked off the sell zone. Where were you? I have it all marked out here and everything. Where were you? Okay. You may also noticed yesterday, if you were in the special event that I held yesterday, you actually saw me move my stop loss to lock in profit, on the USD Mexican peso based on the volatility that occurred. So I moved my stop here. Okay. And now I can move it even more. I mean, I'm sitting on almost 500 pips profit. But anyways, just to get the idea that we should be heading down here, and then that was very tradable. Okay, cool. Oh my God, I got so much to do today. What else is going on? So we did a lot of these quickly, but we can go over them again. Okay, there might be some play here, maybe on the hourly. Not so sure. I marked it a little higher earlier, so we'll see if there's a bit of an interesting move going on. Like this, euro dollar shouldn't be going up, quote unquote. CAD's probably going to weaken based on the central bank meeting in 25 minutes. But there might be some dead cat bounces today in the stock market and all that kind of stuff. So be careful with euro dollar. Okay, watch the hour, watch the 4 hour, all that kind of stuff. Very, very, very oversold. Okay. It's not a buy. That's not how that how to read that. This is not a buy, just so you know, because there's a built-in assumption of like this. Okay, so a double bottom has not been confirmed. Okay, so anyways, yeah. Lot of mediocrity on the short run here. You want to look at the 15. 15 is actually bullish. Hourly says get ready to sell. Get ready, because this ain't funny. My name's WMD and I'm about to make money. Pulled out the kiwi and aimed it at the sky. Yelled, stick 'em up and let two fly. Okay, anyways, so yeah, gotta go. Interesting day, interesting markets. I hope you're doing well. Hope you're happy and safe. And if you like any of the ideas I discussed, email me. Let me know your thoughts, because I'm thinking about it. It'll take me a while to put it together, but that's what I'm thinking of anyways. So peace on earth, may the pips be with you. May your profits be above average. That just happened.